Stocks won the week, bonds did not. Buy it. AP puts the S&P 500 up 1% for the week. Amazon jumped 15.3%. Microsoft gained 15.51% the day before, but the 10-year Treasury yield finished at 4.718%, and Brent crude settled at $87.93. That combination matters more than the green index close. A few large companies gave investors measurable earnings proof. Oil and long rates kept the inflation hurdle high, so this was not a simple all-clear rally. It was a test of whether company results could overpower tighter financial conditions. We will use 5 charts to separate the forces, then set 3 conditions for the next close and map the data that can change the read next week. AP's weekly tally has the S&P 500 up 1%, the Dow up 1%, the Nasdaq up 1.6%, and the Russell 2000 up less than 0.1%. Friday carried the indexes over the line. AP's Friday tally has the S&P 500 at 7,489.72, up 0.7% for the day, and the Nasdaq up 1%. Those numbers show a winning week. They do not show broad agreement. The Russell result matters because smaller companies usually have less index weight and more exposure to financing costs. The large cap indexes can rise when a handful of very large stocks surge. A nearly flat Russell says the weekly headline reached farther than the participation underneath it. That is the distinction. Price went up. Breadth did not confirm the same degree of confidence. The other distinction comes from bonds and oil. The 10-year yield and Brent both finished high enough to keep the inflation problem active. The rally had to climb over that obstacle instead of receiving help from it. Amazon supplied the clearest Friday example. The stock gained 15.3%. AP reported that quarterly profit more than tripled from a year earlier and that cloud growth accelerated. Investors could connect spending on artificial intelligence infrastructure to a current operating result. That does not guarantee the next quarter. It gives the market a number it can test again. Microsoft showed the same preference on Thursday. The stock closed at $451.10, up 15.51%. Microsoft reported quarterly revenue of $90 billion, up 18%. Azure grew 43%. Remaining performance obligations rose 84% to $678 billion. That last figure is contracted business that has not yet been recognized as revenue. It is not cash in the bank, and execution risk remains. It does give investors a visible bridge between spending today and potential sales later. The shared mechanism was current operating evidence. Both companies are spending heavily. Both showed that demand is reaching their cloud businesses now. The market did not reward the letters A and I by themselves. It rewarded results that could be measured against a very large bill. That distinction is useful because high long-term yields make waiting expensive. When the discount rate rises, distant earnings lose value relative to cash earned sooner. A company can still justify heavy investment, but the evidence has to arrive faster or grow larger. Amazon and Microsoft met that test this week. The index benefited because both stocks carry substantial weight. That tells us why equities won. It does not remove the rate pressure. The 10-year Treasury yield ended Friday at 4.71%, compared with 4.68% Thursday. AP reports that the same yield stood at 3.97% before the war with Iran sent oil prices higher. The TradingView chart records Friday's close at 4.718%. That is above the visible 4.600% line and near the top of the 1-year range on this screen. A long yield can rise for more than one reason. Growth expectations can improve. Inflation expectations can rise. Investors can also demand more compensation for holding long-dated government debt. The chart does not separate those causes by itself. Oil gives us the transmission channel. AP reports that Brent settled at $87.93 on Friday after trading between $72 and $102 during July. Oil feeds into transport, freight, and production costs. The longer it stays elevated, the harder it becomes for the bond market to treat the shock as temporary. AP reports that the Federal Reserve held its policy rate this week. 3 officials dissented in favor of a hike. The policy decision did not pull the 10-year yield lower. That leaves financial conditions doing the talking. Equities priced strong company results. Bonds continue to price an inflation and term premium problem. Both can be true for a while, but the tension has a cost. The S&P 500 closed at 7,489.72, while the 10-year yield closed at 4.718%. If falling rates had powered the equity gain, we would expect the yield to move down with the rally. It moved up. My read is that earnings proof is the cleaner explanation for the equity result. The same cross-check helps with oil. Brent at $87.93 did not signal a clean return to the lower end of July's range. Stocks rose while the input cost warning remained visible. This is not a forecast that stocks must fall. Markets can pay for earnings growth even when rates are high. It means the burden is concentrated. Companies with current profit, cloud growth, or contracted demand have evidence to carry the valuation. Companies asking investors to wait face a tougher calculation. The nearly flat Russell adds another piece. If the week had been a broad easing of financial conditions, smaller companies would have had a clearer tailwind. Instead, the strongest evidence came from the biggest earnings reactions. So the weekly result was positive and selective. The next close has to tell us whether that selectivity can keep supporting the index. Start with the index. It closed at 7,489.72. The visible upper decision level is 7,636.59. The important lower reference on this one-year chart is 7,002. Amazon closed at 271.58, just below 274 and above 258. Friday's gap approached 274, but the daily close did not clear it. Microsoft closed Thursday at 451.10. Its next visible upper level is 466.32. The lower level that protects the earnings reaction is 398.01. Now put those equity levels beside the bond chart. The 10-year closed at 4.718%, above 4.600%. That 4.600% line is the simplest test of whether the rate hurdle is easing or staying firm. Every condition uses a daily close. An intraday touch can show interest. It does not show acceptance. The levels are not price targets. They are a way to force the equity and bond evidence into the same decision instead of writing a news story for every tick. Base case, the S&P 500 stays below 7,636.59, but above 7,002. Amazon closes between 258 and 274. Microsoft remains between 398.01 and 466.32. The 10-year yield stays above 4.600%. That would preserve the current tension. Large company results would steady the index, while long rates would keep broad participation uncertain. Confirmation: the S&P 500 closes above 7,636.59, and either Amazon closes above 274 or Microsoft closes above 466.32, with the 10-year closing at or below 4.718%. That combination would show the market accepting higher equity prices while the bond pressure stops intensifying. Those reported results would still be carrying the move. In validation, the S&P 500 closes below 7,002, or both Amazon closes below 258 and Microsoft closes below 398.01, while the 10-year remains above 4.600%. That would break the claim that company-level proof is containing the macro pressure. The equity evidence would weaken while the rate hurdle stays in place. These conditions can fail separately. One stock losing a level does not decide the whole market. The mechanism changes when the index, the earnings leaders, and the long yield begin pointing in the same unfavorable direction. Monday brings the ISM manufacturing report. It tests whether factory activity is improving and whether input cost pressure is spreading beyond oil. Tuesday brings the June job openings and labor turnover survey. Job openings can show whether labor demand is cooling fast enough to reduce wage pressure without breaking employment. Wednesday brings ISM services. Services cover the larger part of the economy, so the activity and prices components matter for both earnings demand and inflation risk. Thursday brings preliminary productivity and costs for the second quarter. Productivity can absorb wage growth. Unit labor costs can pass it into prices. That report connects the labor story to margins and inflation. Friday brings the July employment situation. Payroll growth, unemployment, and wages can move both sides of this week's divergence. Strong labor data can support earnings demand and keep yields high. Weaker data can pull yields down while raising questions about revenue growth. The sequence matters. Manufacturing and services describe activity. JOLTS and the jobs report describe labor demand. Productivity and costs tell us how much of that demand becomes inflation pressure. No single release settles the week by itself. The useful question is whether the data lowers the 10-year hurdle while earnings leaders keep their chart levels. Stocks won because Amazon and Microsoft supplied measurable proof. Bonds did not buy an easier inflation regime. Brent kept the cost channel open. The 10-year closed at 4.718%, and small caps barely joined the weekly gain. Watch the S&P 500 at 7,636.59, Amazon at 274, Microsoft at 466.32, and the 10-year at 4.600%. If earnings leaders hold while the long yield stops rising, the weekly read is intact. If those leaders lose support while the yield stays high, the mechanism has changed. This is general market education, not financial advice. Subscribe for the next post-close map after Monday's August 3rd ISM manufacturing report.